Thank you everybody for joining us today. My name is Sarah Hilliard. I'd like to welcome you to the Prevail webinar series. Today we are speaking on the financial sector outlook. Before we get started, it's just a little bit of a background about Pascal Financial. So we are a technology company that's located here in Toronto, and we are providing wealth technology that's in a digital space, uses AI, and leverages really about getting to know your clients in a different way. We believe that there's a digital renaissance that's going on in the industry, and we are happy to participate in delivering advice for you to deliver advice to your clients. So we have a comprehensive set of capabilities that includes client management, client onboarding, portfolio management, compliance overlays, and custodial integrations. So all of these tech modules are API driven and very much modular and meant to all bring out some different aspect of showing the value of your advice and really about bringing that client advisor partnership together. The team behind Pascal is a series of leaders in the industry that have been advocating for change and innovation for a long time. So we include entrepreneurs, wealth management experts, we have asset management pioneers, and behavioral finance leaders. And as part of the COVID initiative, so we have Prevail, which is a subset of our technology platform. And when COVID, the pandemic was happening, and the ability to meet face-to-face was becoming problematic, what we did is we came together in the industry and we took a subset of our modules that really focused on the engagement piece between advisors and clients. And we made this through our partners available for free during these weeks. In addition, we've been supporting this webinar series where we've been looking at other impacts to the investment landscape. So we've done a little bit about technology and how you can leverage technology in new ways. We've brought in the concepts of how do you leverage behavioral finance, and this is an opportunity to get to know your clients in a different way. We've brought in mental health awareness through the Canadian Mental Health Association. So we have different triggers and strategies for how we can talk about the stresses that we're all going through, as well as with your clients and the partners here in the industry. And then we've kicked off a series of reviewing different investment strategies. So we've talked about covered calls, the real estate and infrastructure, the dividend outlook. We've also covered the new capital markets, which is the private capital markets, and some innovations that are happening there. Last week we had the alternative landscape, and today we're very excited to talk about the Canadian financial outlook, the big banks, and the global outlook for these financial institutions. We will be having 2 more sessions as part of the Prevail series in July. And so we'll give some details about what the topics to come at the end. Just as a reminder, so all of our webinars are available for advisors to replay. We've made that available on the Prevail website. So they're all recorded about 1 hour in length. So if there's something that you've missed and you'd like to catch up on, we welcome you to come watch those. In addition, our client management capabilities that we made available, we have a number of tutorials that we can send you these links on separately that really walk through what does it mean to do the embedded appointments and video calls, client management in a digital way, what's the engagement hub, and how to redistribute information in a different way with our clients, as well as the secure inbox and messaging. So these are all available. So with that, I'd like to now introduce and bring Yves, Yves Rebete is the CIO at Pascal Financial, and he's going to be leading our fireside chat today. So I'm going to turn this over to Yves.
Thank you very much, Sarah. Good afternoon, everybody. I'm very pleased to be joined by Rob Wessel this afternoon. Rob is a managing partner and co-founder of Hamilton ETF. His expertise lies in the realm of the financial services sector. And obviously it's a sector that's dear and near to everyone's mind here, seeing that you are advisors. And interestingly, obviously, in the times that we're living through at the moment, it's a sector that has a lot of different moving parts and a lot of challenges potentially ahead of itself. So Rob and his team at Hamilton Capital spend a lot of time dissecting what is happening with Canadian banks, with other financial companies in Canada, as well as they scour the world to look at the overall picture for the financial services sector, where the opportunities lie, where the challenges lie, where the risks are. And we thought today we'd take the opportunity to have a chat with Rob, and we'll invite you as well if you have any thoughts or comments that you'd like to share or questions you'd like to address to Rob. We'd like you to be able to do that as well. So Rob, first of all, thank you very much for joining us. I'm going to turn it over to you now and just ask you if you could sort of set the stage a little bit for us as to what you're looking at, what's been happening through this pandemic and the bear market that's been triggered by it. So first of all, the Canadian space, and then we'll kind of move along, look at the US a little bit, and then look at the global picture and look at the various areas of financials that you guys are monitoring and interested in and seeing opportunities within, or potentially avoiding risks off, if you will. Rob, over to you.
Great. Well, thank you very much to you and your team, Eve. Really appreciate the opportunity to speak. And can you hear me okay?
Yes.
Okay, perfect. Just a quick, if it's okay, I just want to take a minute. For those on the phone who are not familiar with us, our firm Hamilton ETFs, we specialize in the global financials. We offer 5 ETFs. One is Canada, one is Australia, some US, and 2 global mandates, including fintech. So our team has 4 experienced portfolio managers. We have about 60 years of experience. And then I also wanted to flag that for those of you who are not familiar with us, you can go to our website, hamiltonetfs.com, where you'll find 9 years of research commentary, including a heavy dose of commentary on the Canadian banks. There is some noise in the background. So in terms of thinking about what's going on right now, so obviously the virus and this sort of self-imposed recession, if you will, almost government-mandated recession, is the overwhelming variable that's affecting everything. So the financials are cyclical. So if you think about, the different categories of financials, whether it's banking, insurance, brokerage, they're all impacted differently, or we'll say non-bank or non-pillar financials, I guess, if you will. So what's happened, I guess, with these extraordinary series of events is you now have, basically starting on, we'll call it February 15th or 14th or the 20th, you saw the market trade off very sharply off of the expectation that economic growth was set to plummet and that you were entering a credit cycle or a recession, and therefore, the financials being cyclical, for them it would be a credit cycle, primarily for the banking sector. So, now you have seen this extraordinary move down. So basically from February 14th, give or take, until March 23rd, which was the low, or the low so far, the Canadian financials or banks fell about 40%. The Australian banks, which are basically fraternal twins, fell 40%. And then everything else fell anywhere from 45 to 55. So what you've seen since then is a couple of things. Quite a few things have happened in the meantime, but you have seen, the financials bounce. So we've spoken about the financial sector, and we're obviously entering a credit cycle. So what's this credit cycle going to look like? Because of course that's going to drive everything. We've said, particularly as it relates to the Canadian banks, that the cycle will be, first, it will be severe, i.e. loan losses will rise to a level that you haven't seen in a very, very long period of time, including the global financial crisis, number one. Number two is that the cycle, though, unlike most cycles, which typically last, or credit cycles, which typically last 4 to 6 quarters, this one's probably going to be 2 to 3 quarters. So it's going to be severe and short, and quite frankly, it's going to affect everything. Usually, credit cycles or downturns from a banking perspective are led by one particular loan category. This one here, it's likely going to be everything. So what happened? You saw, the first quarter reported for pretty much everything, whether it was the US or Canada or globally. And you saw something that was, which was expected, which was a very significant increase in loan losses. What you didn't see, or what seemed to be new information, everybody on the phone probably knows that Canadian banks rallied not unexpectedly after they started reporting, which was, it looks like the downturn so far isn't going to be as severe as the analysts have forecast. Now, of course, the elephant or the hippopotamus, whatever you want to say, in the room is the virus. So when Eve mentioned us globally, one of the things that we pay a lot of attention to is the trends with respect to the virus. Now, recognizing that the data is all over the place, the experts have been regularly wrong, and we're not epidemiologists or anything like that. But when the economy is going to restart. So to the extent the virus, and however you want, whatever metrics you prefer to track, when the economy restarts, how fast, or sorry, when it can restart, how fast it can get to, we'll call it pre-virus GDP, and what's the risk of a second wave. Those are key variables. So let's use Canada and Australia, for example. Canada, the virus took hold in Canada. We're actually doing not too bad globally, certainly better than Europe, probably marginally better than the US. So, it would appear, that we're set to restart. It looks like economic activity will pick up. So now the question is going to be, how long does this take, and what's the what's going to be the impact on the economy? How long does it take, and then also what happens to fiscal and monetary policy? But then we'll use Australia. Australia had a very early travel ban, so they have almost live cases, active cases of something like 400 new cases a day, or less than 10. So if you look at Australia versus Canada, Australia is more likely to start its economy faster. They're typically wealthier and grow faster than us anyways. They're more likely to get to February, pre-virus GDP faster, and they're much less vulnerable to a second wave. So that's an example of where, we might look around and say, okay, well, over here, this is what's going on with respect to the virus and how it relates to the economy. And then over there, how is it different and contrasting? Because of course, if you're cyclical, if you think the financials, if you are bullish, the financials by definition, depending on what geography you're in, by definition, you're making a call on when the economy restarts, whether you know it or not. And then I guess the second thing I would point out is once you get through this this surge of loan losses, then you're going to have to deal with the after effects of the monetary policy response, which was massive injections of liquidity and rates which would appear to be very low for a long time. And so the secondary effect after you get through this credit cycle is going to be what happens to each category of the financials as a result of these low rates. And those are those sort of three things are the things that are driving the financials right now.
So that's the restart and the pace of restarting. There is, as you mentioned, a lot of uncertainty still. There is the impact on net interest margin, obviously, over the long run, which cannot be discounted. But I guess people on the line, advisors in Canada in particular, probably very often concerned or hearing from concerned clients with regards to the safety aspect of the dividend side of the equation for the Canadian banks, for example. So curious about if you can speak a little bit to that, what your expectations are in regards to, are there any risk in the Canadian financials with regards to dividends, for example, and how that contrasts with some other geographies, such as, for example, Australia?
Yeah, so that's obviously a key question. We actually did a webcast on the credit cycle in April, and we had about 900 advisors on it. So that spoke to just the sheer level of interest and concern around the issue that you've identified, Eve. What we would say is probably somewhat foreign, if you will, to the average Canadian's perspective. Is we would accept that the Canadian banks are unlikely to cut their dividend. In fact, we would assign a near zero probability of that. But we'd also point out that that's not an overwhelmingly positive thing. And so here's where I think Canada and Canadian bank investors have somewhat of a incomplete understanding of the issue. So it's helpful to sort of step back and say, why have the Canadian banks up until, National Bank in 1991, why did they never cut their dividends? And the answer is, answering that is actually quite helpful. Number one, the regulator in Canada, OSFI, is very, very pro-bank, very much prone to regulatory forbearance, doesn't mind if capital ratios fall. The Canadian banks, many people don't know, actually operate near the world's, they have basically the world's lowest capital banks. But second, which is probably more important, is that the Canadian banks, if they need emergency capital, they'll raise equity. And so I have a perfect example for you. CIBC in 2008, they lost $2 billion during the global financial crisis. In that year, they paid out $1.3 billion of dividends. So they depleted their capital by $3.3 billion. And then they raised $3 billion of equity. So essentially what they did is they raised equity to cover their dividend. So it is undeniable that CIBC stock price would be meaningfully higher today had they cut their dividend in 2008. So I understand the idea that, especially and I'm not diminishing the importance of it, we're only talking about shareholder value and stock prices here. I understand that a lot of people for very understandable reasons, like the idea that dividends are never cut. I would just point out that it's not necessarily as pro-shareholder as everybody would believe. I think it's undeniable that CIBC stock price be meaningfully higher today had they cut their dividend 13 years ago for a period, which would take you to Australia, for example, which has a more mature way of thinking about this issue, or more, I would argue, more pro-shareholder view of thinking about it. And same with other countries. Is in Australia, they are actually reducing their payouts somewhat. They have much, much higher payout ratios, but they're doing it and their stock prices are rallying because they're saying, we'd rather reduce our interim dividend in a short period of time so we don't have to raise equity. And so, yes, you get a little bit of volatility on the dividend side, but they're not so dogmatic. But at the end of the day, one of the reasons the Australian banks have outperformed the Canadian banks over such a long period of time, including the financial crisis, is because they have a more flexible approach to capital deployment. So bottom line, everybody on the phone wants to know, and I was a former #1 ranked Canadian bank analyst, are they likely to cut their dividends? The answer is no. This is just not severe enough. It's not likely to get any losses. OSFI is going to let them grind capital. They're very, very pro-bank. You saw that again today. But I would just further add that it's not a positive as you think. And so having said that, it's not certain whether the Canadian banks will issue equity. They all stopped. 3 banks stopped at a common equity tier 1 of 11, which is a very, very important capital constraint. So what we don't know is if OSFI is going to let them fall below that. And so I think it's possible that you see some modest EPS dilution, but not a dividend cut.
Interesting. So, obviously Canada has one significant element, or a couple of significant elements attached to our economy and attached to our investors and our clients, if you will. I'm not sure where Australia sits on that particular front with regards to, for example, their real estate market and the degree to which it had or had not corrected. But we certainly all know that in the US, we've had 08, 09, that took away a lot of imbalances, if you will, in terms of the real estate market. I'm curious, we all know that the pandemic obviously was seen first off as obviously a health issue, very much, as opposed to a financial crisis. I'm curious as to the extent to which one has the potential to sort of morph into the other. In other words, for Canada, having never really corrected real estate since the significant rebound of the early 90s, decade-long real estate not really going anywhere kind of thing. So we've got that as the backdrop, and we've also got as a backdrop, I think, the distinction of being one of the very few geographies that has an extremely high ratio of debt to income. So I'm interested in your thoughts on that.
Yeah. So that's actually an extremely good question. So let's start before the virus. So obviously, home prices have been up in Canada a lot. We actually wrote a big comment on our website on the real estate and mortgage books of the Canadian and Australian banks. So there's about a year ago we wrote that. So first things first, countries with high home prices have high consumer debt levels. You can't have it can't be one without the other. If you have high home prices, you have high consumer debt levels, number one. So then the question is, okay, we know what we learned in the global financial crisis from the U.S., but the issue here is the U.S. market is very separate and distinct. Without boring everybody on the phone silly, U.S. residential mortgages at the time was about 10 trillion. 5 trillion was on the balance sheet of Fannie and Freddie. 2.5 trillion was in the MBS market, and about 2.5 trillion, or 25%, was in the banking sector. And they don't really have the same widespread usage of mortgage insurance, and when they do, a lot of it was held and underwritten by private companies. So, okay, so we know we had a big real estate, crazy real estate bubble in the United States. We know what happened in the United States. It was and not to review, everybody knows, but bottom line, it was really bad. So fast forward to Eve's question, which is, those pretty significant increase in real estate prices, as you correctly pointed out, Eve. There was no real correction in Canada. Interestingly enough, Australia actually had a roughly similar increase in real estate prices, but in the last, again, before the virus, real estate prices actually came off quite a bit in Australia. So quite a bit of the froth came out of the market. That's not to say home prices in Australia were not high. It's just that Canada didn't. So now here you are today, you're asking the question, okay, well, if the pandemic results in a significant decline in real estate prices, what might that mean for the financial sector? And here's where the difference is in the mortgage markets between Canada and Australia and the United States come into play. So in Canada, mortgages are on the bank balance sheets, where in the United States they weren't. So one of the problems in the US is you had a disconnect between who was underwriting and who was taking the credit risk. In Canada and Australia, you don't have that. The people who are keeping the risk on their balance sheet are the ones who underwrote it. So I would say, if you look back historically, losses from residential mortgages on the Canadian banks, and indeed the same for Australia, have been effectively zero. So why have they been zero under almost any circumstances? And the reason for that is number one, there's a wide use of mortgage insurance. So here you look today in Australia and Canada, for example, for every $100 of mortgages, you have roughly $200 of home value. So you basically have what they call loan to value of 50%, meaning, so things have to fall an awful lot. This is before you even talk about mortgage insurance. You have $2 of collateral for every $1 of debt outstanding. So the systems are built to have substantial collateral supporting these very, very important loan categories, which serve as the feeder to all the other loan categories like credit cards and lines of credit and home equity and things like that. So it's very, very difficult to get any losses from home prices as a result. Now, hold that thought. And then there's mortgage insurance. So the riskiest category of mortgages, as everybody in Canada knows, you have to basically self-insure yourself. You pay premiums to insure against your own credit risk. Same with Australia, although it's a little bit different, but suffice to say, the analogy works very, very well for both. So I think it's not likely, if there was a very rapid and significant decline in home prices, that you would see rising mortgage loan losses for either sector, or the US for that matter. But to the extent that falling home prices and therefore falling commercial real estate prices result in lower construction activity, which is, give or take 15% of GDP, whether it results in lower consumer spending, lower consumer confidence, higher unemployment, those are the sorts of things, the secondary impact, which would mean that you probably had lower revenue growth, moderately rising loan losses, but it's not a systemic event. And the US just went crazy, and it's just not really a transferable experience from the United States to Canada. Really, what happened in the US is very unique to the US because the banking sector is not the primary underwriter of mortgages.
Rob, Hassani here, just chipping in. If you don't mind extending on that for the audience, when it comes to the Sched B institutions here, when it comes to mortgages, so the home capital and an equitable group, how does that play in when individuals are being made redundant and then they have to become entrepreneurs, so self-employed? How does that impact the banking system, and what are your thoughts there?
Actually, so we actually don't really follow the Canadian small cap or mid cap financials. So I'm not really, excuse me, I'm sorry. I'm not really an expert on home capital and Equitable. So I don't know that I could comment on them. I think that if we were, without commenting on them in particular and saying, okay, well, are there mortgages outstanding? Are they systemically important? The answer would be no. So my lack of knowledge of them shouldn't be all that harmful to answering this particular question. So do they have higher losses? I mean, they would tell you that they have very significant loan to value, and I'll take that as a given. But I'm not, to be honest, I'm not 100% sure what percentages of their mortgages would be insured, for example.
Okay.
So I got to go with I don't know.
Fair enough. At times like these, obviously, people are looking for strength, but as well, they are looking very much at vulnerabilities. I think in general terms, if we look to the Canadian banks and the Canadian economies, one additional concern above and beyond the indebtedness of the average Canadian and respectively risk to the mortgage market, so to speak. The other one would be obviously energy and the exposure that in particular Alberta has to the whole energy situation, which I think we all know wasn't exactly helped by the fact that as the pandemic started to take hold, or even shortly before then, Russia and the Saudis embarked on some sort of a feud or a price war. And caused problems in the Canadian energy space, which could be reminiscent to an extent as to the eventual outcome to what happened in 2015, 2016. So sort of wondering about your thought in relation to this and in relation to financials.
Oh, okay. Well, so here's a plug for our website. We actually posted a note on May 15th called Canadian Bank's 3 Vulnerable Loan Categories and Charts, and one of them was oil and gas. So there's no question that the Canadian banks have exposure to the energy sector. So it's the Big Six average as a percentage of total loans is about 2.2%. Now they would make all kinds of distinctions about why it's the average credit risk of your average oil and gas loan at a Canadian bank is lower risk than the loan category writ large, and that's fine. Let's accept that. I think it was fairly obvious that the Canadian banks were going to take higher loan losses, but we did actually learn, and I'm glad, Yves, that you brought up the 2016 kind of mini credit cycle, because one thing we learned is, the banks, and we did a webcast actually at the time, which is, how worried should you be, was the title of this webcast a couple years ago. And the answer is not terribly worried about oil and gas. I mean, again, speaking of the direct loan exposure on the Canadian bank, so 2.2% of loans is not all that bad. You did see them take very big reserves against them. I think what we've said about oil and gas is essentially it's just one of many problems that the sector faces right now. So the bigger issues are, what we learned in the quarter is corporate overall. Commercial, or what you would call SME or small medium enterprise, was very, very tough, and also consumer. So consumer loans are typically not, when you think of a credit cycle for Canada or elsewhere, typically consumer loans are a tag in. Almost every credit, in fact, every credit cycle has been led by a commercial loan category, whether it's commercial real estate, telecom. Again, I'm talking about Canada specific, energy loans, LDC, all the way back. Those were typically the leaders, and consumer followed. Here, by nature of this downturn driving unemployment so high, one of the points we made is that unique this cycle amongst others, or compared to others, is that consumer is going to be a real factor. So a lot of people don't realize that TD Bank has a pile of indirect auto loan exposure in the United States. They don't realize that they have a pile of credit card exposure in the United States. And guess what? They were a big underperformer this downturn, this most recent quarter, and they were constrained by capital in the reserving. And that's because TD Bank today does not look like the TD Bank of 2008. They have massive consumer exposure relative to what they did before. And those are high loss content loan categories. And so you asked about oil and gas, and I'm answering with consumer. What I would say with oil and gas is it's not really the problem like it was in 2016. Even if it wasn't a big problem in 2016, it was the problem. Here, it's just one of many problems. And that's why when we did this huge webcast in April, we talked an awful lot about the characteristics of the credit cycle, but also adding all of these things together and having effectively it impacting everything was going to see a provision ratio, what they call a loss ratio. Typically, a Canadian bank would lose about 40 cents out of every $100 of loans every year. And in a normal time, they're running about 35 cents. We said they were going to move to well over $1 or 100 basis points, and that would be very severe, not to get too technical on the phone. And they came in at 133. So this is a tough credit cycle, but oil and gas is just one of many components of it. Interestingly enough, if I could throw in a comment on Australia, because we like to compare the two because they're basically fraternal twins. In Australia, they have very little consumer debt, and they also have very little energy debt. And then that takes you to oil falling and this terrible confluence of events or convergence of events, if you will, between Russia and Saudi Arabia combined with the pandemic and the demand destruction that came from that. Interestingly enough, in Australia, the falling energy prices is a clear positive because it's stimulative to the economy, and the banks don't really lend money to anything other than a bit of natural gas. Whereas in Canada, not only is it a variable in their balance sheets and their loan losses, but it's obviously important to the province of Alberta, which is extremely important to the Canadian economy. And so there's no question falling oil prices, are disproportionately negative to the Canadian banks versus virtually every other global bank. In the U.S., there's probably 10 or 12 U.S. mid-cap banks that have heavy energy exposure, but everybody knows what they are, and they're in Oklahoma and Texas, and but I would say it's a problem. It's in and of itself. If it was only oil, it wouldn't matter at all. It'd be like 2016, but unfortunately, it's one of many problems this year.
So you've touched on TD Bank. Obviously, has made a huge push into the U.S. I think that started even before the financial crisis, and then every single one of them in the aftermath of the financial crisis has pushed different strategies into the U.S. Into the U.S. market as a way of essentially, I guess, grow, because in Canada they pretty much grown as much as they ever were going to be able to grow. I'm sure you've heard that concept too, because it's one of those sayings that people kind of go back to on and off. That one of the Canadian banks has been labeled as the one that was always the most likely to walk into a blunt object, and I think you know the one I'm talking about. What I'm getting at in terms of the question is, can you give us a bit of a relative view of the Canadian banks' pursuits or endeavors in the U.S., kind of taking the comment you made regarding TD further into what the kind of environment we're in spells out for the other Canadian banks that have also pushed out quite a bit of capital into the U.S.?
Yeah, so, well, we've definitely been writing at length about this subject for at least 20 years. I think I've been, I've probably, feels like I've written the equivalent of 2 books on capital expansion, or capital deployment, excuse me. So in Canada, just, banking 101, for every $1 billion of earnings a bank would have, they'd probably pay out $45 in the form of dividends, at least where we are today in terms of payout ratios. They probably need $15 to grow. So that's, that takes you to $60. And so then they have another $40, or 40% of all earnings not paid out in dividends, or all earnings, excuse me, is basically, okay, what do I do with that? And that presents a problem or a challenge, a strategic challenge, because, Royal Bank makes $2 billion a quarter. So, okay, so Royal Bank makes $2 billion. They pay out $800 million or $900 million of dividends. They need, $200 or $300 million to fund balance sheet growth. And then they have another $700 million plus that they just, now, what do I do with this? And so the Canadian banks are constantly building capital, and therefore, this is in normal times, not in a credit cycle. And there's this pressure to make acquisitions. In Australia, by the way, they have very high payout ratios, so they give the money back to you. So you have a little bit less dynamic. So what does that mean? It means, so we have written often and spoken often that Canadian investors' expectations for returns for the Canadian banks were too high. That we wrote this about 10 years ago, because they did the easy thing, which is they crushed everybody in Canada. So they bought every investment bank. They bought every, they either destroyed or absorbed, every wealth management asset. Any small institution and around that would be absorbed, or they, they've stripped their market share. You go back to the 90s, taking out the trust companies and so on. Bottom line, as you pointed out, the Canadian market is completely consolidated. So now, over the last 15 years, they've at varying paces, in various degrees, they've pursued foreign expansion strategies. Okay, so TD, if you want to go in order, we'll do BMO, which has been in, probably had the one of the older strategies. So they have a very good platform in the U.S. Midwest. They're focused on commercial banking. They've been very disciplined. Their first acquisition of Harris was 35, nearly 40 years ago. They bought a company called Marshall and Isley, an excellent U.S. mid-cap bank, which was in distress. They bought a tangible book. So BMO is in very good shape. So they have a very high-quality platform in the Midwest. The problem is Illinois is a terrible state. So they're up into Illinois and Wisconsin, and to a lesser extent, Minnesota. So they don't have great geography. You may or may not know, but Chicago is actually shrinking. And one of the worst demographics in the United States is the Chicago metropolitan area. So then you go to Bank of Nova Scotia, which has also a very, very good foreign platform. It's very diversified. It's emerging markets focused. They're focused on what they call the Pacific Alliance, and then obviously they have operations in the Caribbean. And that's probably, that's definitely one of the better platforms, and they've done very well. They have suffered more recently, again, pre-pandemic, because they started to build their wealth management platform, and they bought Jarislowsky and MD Financial in the market, put them in the penalty box. And that's worth just a brief segue. Whenever a Canadian bank enters into a very significant new direction, or they surprise the market, or they make large capital deployments, they see their multiple compress. So Bank of Nova Scotia saw its multiple compress, and this happens all the time. So hold that thought. Then you go to CIBC. So I did say in this big webcast that we did in April that coming out of this downturn, CIBC was going to be advantaged, and that this is going to be the first downturn in everybody's memory where they do just fine. I do not believe they're going to underperform. In fact, I think it's likely that they'll outperform, and that was our prediction going in. And indeed, they had a very good quarter. So they were definitely one of the better performers. So I don't think that the problems that they had in the past should be extrapolated to the current. This is really a different CIBC. They bought a mid-cap bank called Private Bancorp, based in Chicago, a bank that we knew well because we've been following that category of banks for nearly 20 years. Private Bancorp is an excellent bank, commercial bank, very, very high growth, very idiosyncratic, and nearly perfect fit for a Canadian bank. So that was actually a very good acquisition. Worth noting, the market hated it. The strategic rationale was unimpeachable. It was an excellent bank, a perfect strategic rationale, some geographic, it's relatively close in terms of flights, and the market didn't like it, and they were left in the penalty box. But I believe and continue to believe that that subsidiary will hold them in good stead. Having said that, it's worth noting that their multiple went down so much, the market that drove their cost of capital so high that they really were forbidden from making other acquisitions or became uneconomical. National Bank, another example of a bank that took a different approach. The market didn't like it, but they were richly rewarded. National Bank started to withdraw from retail mutual funds, first with NatCan, and then they had an interest in Fiera, and then they kind of moved away from that. The market did not like that because at the same time, they bought a bank in Africa. So they've been utterly vindicated. If you look over a 20-year period, I'm amazed at how many people don't own National Bank when it's basically been the top performing bank over 20 years. It's definitely one of the best managed. They did extremely well this quarter. They had an ROE of 10% after a 4 times increase in provisions. They're the most profitable bank. They're in excellent shape. And so where they go from here is not going to be obvious. And then you get Royal. They have the biggest, most diversified, and probably the highest quality foreign platform of any bank. RBC, the 3 best banks in the world would be probably RBC, JP Morgan, and Commonwealth Bank of Australia. So RBC, one of the great things about them is they don't have the same reinvestment risk as everybody else. Like if you're BMO and you generate a bunch of money, it's got to go to your predefined Midwest platform. If you're CIBC, same. The great thing about RBC is they have a top 10 global investment bank. They have an incredibly good US mid-cap bank called City National. And they also have a wealth management platform. So they have a destination for all this capital where they can get deployed organically, particularly their investment bank. So they don't have the same pressure, which is one of the reasons why they have higher ROEs. And then you go to TD, probably easily the most overrated foreign platform. They were off to a good start by buying Bank North, but then they made a transformational acquisition that, believe it or not, closed in 2008. And that was the world's worst timing. There's no question they destroyed significant shareholder value. And they have, generally speaking, not a high quality platform in the United States, all the way into the Southeast where it's very, very junky. And so without boring you too much, but I think this is semi-relevant on the phone for people who own TD, is that they bought this bank, Commerce Bancorp. It was a very idiosyncratic bank. You may or may not find this interesting, so I hope I didn't go too far afield. The guy who made his money with a chain of Burger King, so he started this bank in Cherry Hill, New Jersey, and he was amazing at collecting deposits, but he never loaned any money out. So this is relevant to today. So this is in 2007. So this guy, he built this platform. His name was Vernon Hill, and he had this bank that had a ton of deposits, but only had about $25 of loans for every $100 of deposits. So 25%. The average Canadian and U.S. bank would be 80%. So it was basically a deposits on one side of the balance sheet and a bond portfolio on the other. So the idea for TD was that they would buy this bank. They bought it at the world's worst time, but they have all these deposits that they could populate loan categories. So that's why they went out and bought all these credit card portfolios and this indirect auto loan portfolio. The idea was to buy loan portfolios, plop them into this bank, which has zero cost deposits, and pick up the yields, right? Because the treasuries that were on the balance sheet were making nothing. That, you know, credit card loans, you know, have an asset yield of 15%, and boom, you've got a great strategy, or what it would appear. The problem is that they have a lot of credit risk. So TD Bank, you know, that's a huge platform. I do think that the market overstates the quality. I think the credit risk of it is quite a bit higher than the market realizes and is starting to realize, and that we think that if you were to look at the post-pandemic credit cycle, if the market resorts its views on the individual companies, I think the most likely positive change is CIBC and the most likely negative change is TD. And that TD loses, and TD's already starting to see its premium come down, and that CIBC, I think, sees its relative multiple rise. And those are often, you know, big drivers of excess returns. And basically a long duration mean reversion. Go ahead, I'm sorry.
No problem at all. So the next question, obviously, is as you pointed out, I mean, the banks were quick to take significant provisions, and you know, I guess the question would be, do you anticipate another quarter of significant provision, or have they done enough to this point? And then beyond this, then swinging into the rest of the financials in Canada. Notably looking at a little bit at the insurance space and maybe the mutual fund space. What are you seeing on that side of things?
So to answer your first question is, yeah, the credit cycle is far from over. I don't want to, if I really want to put everybody to sleep, we'll start talking about the new provision accounting. But one thing I would point out is, so yes, there's more losses to come. We think that this credit cycle probably has, you know, the next quarter will be the peak, the quarter after that. So I think they peak next quarter, or the quarter that we're in, and there's another big quarter, and that's it. And then it rapidly normalizes. And the reason it rapidly normalizes is because this new loan loss accounting, which came into place 2 years ago, was building reserves against potential problems for 2 years. And so here we had a big problem. I do think that the banks with the most capital, like Royal TD and Royal National and CIBC, are likely going to come out of this downturn 1 quarter before BMO, Scotia, and TD. So if you have 1 more quarter, let's say we have 2 more quarters for Royal National and CIBC, and maybe 3 more quarters, you know, for BMO, TD, and BNS, or we have 2 and 3. Take your pick, but I think 3 banks are going to come out of this 1 quarter earlier than the other. But that's very virus dependent. You know, when does the economy restart? How long does it take to get to pre-virus GDP? There's a big unknown element of how the banks are accounting for those loans where clients have been granted forbearance. So it's very complicated. So as I said, we do have a webcast replay that we're happy to send out to anybody on the phone if they want a blow by blow of how the credit cycle, you know, could play out, and we have an overview of the first quarter. And so I do think the question is, if you buy the Canadian banks right now, do you buy them today? The answer is probably yes. If you believe that loan losses are going to peak this quarter, which we believe. And so the best time to buy banks is typically before the market concludes loan losses have peaked. Usually before losses have peaked, the market anticipates that if it's correct, then you end up with, significant excess returns. We actually have a mean reversion Canadian bank ETF, which we think is excellent and back test. We have attached it to an index which has 30 years of returns, which people can see on our website. And mean reversion is one of the best themes in a credit cycle because of the variability within the reported results. And we don't even need to pick the right stocks. We just need volatility within the category. In terms of other financials, so we think that you should pretty much be zero life insurance. So we've benefited tremendously by having almost no life insurance in our fund complex. P&C, we can have specialty insurance. I'm not saying we have zero life, but I think the highest allocation we'd have in our global financials would be 1.5% life insurance. So I think what you could see with the life insurers is even if they recover from a profitability perspective, and they haven't really been all that damaged, I think that with the long end being close to zero for the foreseeable future, it's going to be a bit like European banks a couple of years ago, which even though they fully recovered and negative rates didn't actually do that much damage to the income statement, the market didn't care. They just don't like the rate environment, and they have these group of companies trading at very, very low multiples. I think that the banks are going to recover. So, they have short duration assets. Countries like Australia and Canada have oligopolies. They can reprice. The weighted average duration of the assets on a Canadian bank be 2.5 years. You have lots of time to reprice, particularly if you're one of few companies in the market. Not so easy to reprice insurance premiums when you have a 25-year duration liability, right? So if you think of what an insurance company is, on the right side of the balance sheet is one giant present value calculation, which has a whole bunch of variables in it, whether it's mortality assumptions, investment rate assumptions, a myriad of assumptions around protection products. And then on the other side of the balance sheet, the asset side is a giant investment portfolio. So when you underwrite an insurance policy, you make assumptions. If you're going to, if the person is 40, you give them a life insurance policy, you think they might live to be 80. Okay, you're going to price your premiums, to generate premium income, which has investment income. And by the end, you'll have made a good rate of return by the time you have to pay that person out on their universal life. The problem is that the assumptions that you made on your investments is likely to be meaningfully wrong. So I think you're going to see you have quite a bit of risk in the insurance industry in terms of change of assumptions, building extra reserves, and you have literally no visibility in these particular companies. So I think it's amazing. I never would have thought. I covered the life insurance companies when I was a sell-side analyst many, many years ago. And the idea that Manulife would be trading at 7 times earnings or 6 times earnings would seem inconceivable. But here I am today to tell you I don't think that goes meaningfully higher. So I actually really don't think we have no interest in life insurance. We have virtually none. We'll continue to have none. If anybody on the phone owns Sun or Manulife or Great-West Life, I would sell it. And in fact, I actually think, not to sound overly promotional, we actually launched a fintech ETF, a blue chip financials technology ETF for financials innovations, which is going to include things like payments, market data, exchanges, ETF managers, all of the things that don't have the key risks that the core pillars still have, which is interest rates, credit, and principal trading. And so, funny enough, we've actually been going out to people. The fund is only like a week old. We've been starting to say, if you own Manulife and Sun, you should sell them because they're not going anywhere anytime soon, or Great-West or IAG, and look at this type of category because they're not going to be hostage to the interest rate environment. And funny enough, or oddly enough, the pandemic has probably accelerated the digitization of the economy. The challenge on anything that has the word fintech in is fintech has been somewhat, I don't want to say demarketed, certainly not, I don't want to say discredited, but a lot of people see it as overly speculative, but there's a lot of great companies. We have like a $40 billion average market cap in the ETF. That's the category. But I think life insurance is going to be very, very tough. P&C, sure. Again, like banks, short duration assets, they can reprice. And then they have issues around, what's the particular product that they're underwriting. Business interruption is a big one that people worry about right now. But definitely we would say, I could be wrong. It's possible Manulife goes to 8 times earnings and it's a big win. But I just think that what you saw with the European banks where profitability recovered, the macro environment didn't do the damage to the profitability the market thought, and it didn't matter. They just stayed at very low multiples and they've stayed there for 4 years. I think insurance is going to be the same thing. I mean, right now, Great-West Life trades at 8 times earnings, 8.5 times earnings. I would say the upside to Great-West Life is extremely low. And is not a very good risk reward, and that either the banks or non-banks represent vastly superior risk rewards. And we'll see how that goes. But I mean, every day you own a life insurance in a zero long rate environment is probably not a great day.
So let's stick with that fintech angle because obviously that's more of a secular kind of potential disruption. How well positioned are the Canadian banks to deal with this, respectively? When we're talking about, you made reference to ETFs. I take it means the fund that you've put together has some exposure, for example, to BlackRock. When we look at the mutual fund space here in Canada, it's extremely entrenched still. Is this ever going to be meaningfully disrupted, or is this something that is so dependent on the infrastructure here in Canada being so oligopolistic by nature, including the banks having massive mutual fund operations? Is this something that Canadians are just going to have to keep on putting up with?
Yeah. So interestingly enough, I would say the answer is yes and no. How's that for an answer? So the answer is companies like BlackRock and Vanguard and others going to continue to take flows away from mutual funds? The answer is 100% yes. And there's no question that the core businesses of Investors Group and AGF and CI, for example, are facing outright disruption. And that explains why every month that they report or every period that they report assets, they're in outflows. And so I think, yeah, they're massively strategically challenged. We wrote a note on our website a couple of years ago on why AGF should sell itself. Took an awful lot of criticism for that, but I think it was a fair note, and it's still there. You can see it. So I would say, the race is on for CI, AGF, and Investors Group to a lesser extent, to try to dilute down the company's exposure to retail mutual funds because of this disruption. So yes, we have, not only do we have ETF managers in our fintech ETF, we also have ETF market makers as holdings in that ETF, because they're also benefiting from that same structural shift, if you will. But the big but, though, is that I referenced the independents. I didn't reference the banks. So when they have massive brands, overwhelming distribution power, and a very, very pliable regulator, that I don't think you'll see. I mean, I think the Canadian banks' mutual fund platforms will continue to be very good platforms. Will they grow at the same rate they did before? No. Are they going to keep fees high? I would say the answer is yes. There's just not enough pressure on them. And the other thing I point out, and I sometimes feel like I'm the only one in the entire country that cares, but I do think that OSFI enables the banks. OSFI is, I think, a lot of my own view as a sector specialist and someone who's been involved with the financial sector for over 25 years, and now has a global perspective. What I think is really amazing that the average Canadian has no idea is just how pro-bank OSFI is. And I think they've deformed the Canadian financial sector, and that there's a reason why we have no independent investment banks of any consequence. There's a reason why our Canadian mutual fund industry is so damaged. There's a reason for that. And the reason is that OSFI, they allow what are really unacceptable conflicts of interest, or what other countries would deem as unacceptable conflict of interest, If you go into a BMO branch, you're only seeing BMO mutual funds. The person, your financial planner who is ostensibly licensed, does not have to show you a BlackRock ETF. And they can just show you a BMO mutual fund. They have massive MERs. They are, by all accounts, big underperformers against the passive products, but the captive distribution and the hold they have on them would appear to be, at least for now, unbreakable. If there was any, what I think would be great is if we had a new head of OSFI, and I'm not talking about Jeremy Rudin in particular, but OSFI needs a cultural change to be much more disciplined on how they view tide selling in the investment banking sector, which because of it destroyed the independence. And then here you have the the domestic mutual funds that are basically in gradual runoff. But they wouldn't be if OSFI was much more aggressive in policing conflict of interest at the origination point. The branches, have closed architecture, and as long as they do, and as long as they're so big, I don't see that ever changing. So the answer to your question is, as long as the regulator tolerates it, I think there is no change to that, which means right now, part of the Canadian wealth management industry is being disrupted. So then you kind of, I think, alluded in your question, how does that affect the Canadian banks overall? And I would say I don't see any near-term disruption in the Canadian bank model. They're pretty firmly entrenched, and I think the regulator has their back, if you will, almost grossly overfavors the sector. And I say that as someone who is sort of born and bred in the Canadian banking sector, if you will. So I don't want to say I'm an insider, but I'm part of the, I emerged from that particular, part of the economy. But I think as long as OSFI is unquestionably pro-bank and accepts a level of conflicts, that you'll never see that. I'll give you an example, which you might find interesting, because you really do learn a lot when you're global. In Australia, they had roughly the same type of cross-selling scandal that we had here in Canada, almost around the same time. In Australia, which has an extremely strict regulator, they called a royal commission. One of the recommendations for the royal commission, think about this, they actually thought of banning vertical integration, meaning if you're at a bank branch, you couldn't sell your own product in wealth management because there was that big of a conflict. They ultimately didn't do that, but the whole Canadian wealth management sector is built on that principle. And in Australia, literally 8 months ago, they were thinking of banning it. Whereas here, we just take it as a given. So, naturally in Australia, they have a more competitive wealth management sector and one that's healthier than ours. So I don't know that, Visa, MasterCard, BlackRock, PayPal, or Deutsche Börse or ICE or NASDAQ is going to disrupt, the Canadian banks are part of that, that whole, value chain. And I just don't think anybody's going to disrupt them anytime soon. I do think these companies, I do think these companies are going to do very well. They grow, they have much faster growth. The companies that we have in our FinTech ETF, much faster growth, much higher ROEs, and they lack the core risks that everybody is loaded up with in their core financials portfolio, which is credit, capital markets, and underwriting risk. But that growth largely comes in different areas that doesn't really detract from the Canadian banks. It's more of it's other markets, and particularly the US.
Awesome. Okay, so just in rounding things up here, in the interest of time, I guess the Canadian market, as we just discussed, tremendously controlled and owned by the Canadian banks. The US market, on the other hand, a very different animal that remained exceedingly fragmented for so long. You now have a couple of absolute global powerhouses like JP Morgan, like Bank America, and yet there remains a lot of fragmentation and a lot of potential for growth in financials across the states. So what how different is it, or what kind of returns and risk exposures do I have when I look to investing in sort of the mid-level financial institutions in the US relative to just having all of my money in Canadian banks?
So that's a good question. So To those of you on the phone, I did not know Eve was going to ask this, but this is a great. It's a great question. We actually have a U.S. mid-cap financials ETF, which Eve may have already known. So the United States is a much healthier market. It's more toughly regulated. The pillars, if you will, the core pillars, while they have, the market has consolidated a lot, they're still, with the exception of the thrifts, still largely exists. And when you talk about JP Morgan and B of A and Citi, really their global part is really outside of the domestic market. They're global investment banks, if you will. And so I think that, and part of their growth that you've seen in the lot, because they've been such tremendous performers over the past couple of years, has actually not come from anything special that they did. The Europeans basically en masse exited the US investment banking sector, freeing up about 40 billion of fees that not only did these companies, JP Morgan, B of A, and Citi capture, but so did Royal Bank. And so they generated, they were able to soften the blow of what was a shrinking market, which is global investment banking, has actually shrunk quite a bit over the past 10 years. They didn't. It was really at the expense of these global European banks. So what I would say is, in the United States, it's more of a cultural thing. People in the U.S., because the market was fragmented for so long, and there's independence for so long, like we have mid-cap banks that have been in business for 80 years. So if anything, culturally in the United States, they're the big banks, as a friend of mine who covers the U.S. banks calls them, they have negative branding because they're seen as not as customer friendly. They got very big during the global financial crisis, but it was primarily buying these giant thrifts. So as you may recall, JP Morgan bought Washington Mutual, B of A bought Countrywide. So they bought these massive thrifts, but most of the smaller financials, whether it's in wealth management, asset management, or banking, they have certainly on the banking side, more of a commercial focus, and they're very close to their communities. So they're very, very simple, but they're also very competitive. I would say a bigger variable when you think of the US financial sector isn't size, but geography. So one of the big benefits that we think we have in our US mid-cap financials ETF, and one thing that we care about a lot, is you'll remember I mentioned that the demographics of the MSA of Chicago, the metropolitan statistical area, the metropolitan area of Chicago, has very poor demographics and very poor GDP growth. Same, by the way, goes for the New York metropolitan area, which is the biggest in the United States. But there are, because there's 500 US mid-cap financials, you can design a portfolio of high quality, but also crucially, that are in high growth areas. So like in the Southeast, you might be surprised that Nashville, which is a fairly big market, is one of the fastest growing parts of the United States. So it has 4% GDP, this again, pre-virus, 4% GDP a year for the past 4 years, places in Texas, coastal, the US West Coast, Arizona, Georgia, Florida. These are huge places with lots of companies. And so we have a lot of Florida banks. We think TD is probably going to buy 3 of them at some point. And so you can design a portfolio of quality, but it's not really the size that we would say is the big variable. It's the GDP growth of the underlying area, because the biggest trend going on in the US economy right now, at least if you think of the financials, is financial and human capital is moving from the Midwest and the Mid-Atlantic, i.e., the top right of the map, to the Southeast and the Southwest, which is the bottom right and the bottom left of the map. So they have great demographics, large population growth, pro-growth fiscal policy, they're well-governed, and they have GDP growth that's 50 to 100% higher than the national average. That is the big variable. So our US mid-cap financials ETF before the virus had the quality of the companies was so high, it actually had an ROE that was higher than the Canadian banks, and an ROA that was much higher than the Canadian banks, and much higher EPS growth. So the thing with the US is there's so much breadth, and you can get a lot of quality because it's obviously a very, very good country.
Thanks very much, Rob. Food for thought, that's for sure. We could keep going for the whole afternoon. Unfortunately, in the context of the webinar series, we're limited a little bit in time. So we're going to wrap it up here, but we certainly very much appreciate your sharing your insights and your thoughts on financial, both in Canada and in the US. So thanks very much. Thank you for attending. I'm going to turn it back to either Sarah or Hassani at this particular point in time, and we'll speak to you soon.
Thank you.
Thank you, Eve, and thank you, Rob. This was really, again, an amazing webinar. I really hope all the advisors that are online really got the gist in terms of, you know, Hamilton ETFs when it comes to financials is where it's at. And Rob, thank you again. So next week, we'll be taking some time off. Again, it's Canada Day next week. So save the date, which is July 8th. We'll be back with thematic investing and the stay-at-home economy, and how does one pivot in a COVID environment and a post-COVID environment. So we look forward to seeing you all again on July 8th. As most of you are aware, Pascal Financial, we're on the innovative platform Deal Square, where we're raising capital for 1.5 million with the Neo Exchange and Deal Square. So we'll look forward to your support and questions or concerns regarding this raise. As you know, we continue ready to help advisors and firms, again, using our AI-powered wealth management platform with arguably the best engagement tools from both a client perspective that are modular and API driven. And this Prevail initiative actually expires next week, where we will be converting to a subscription-based platform. We, again, couldn't do this initiative without our partners, so we are continually appreciative of their partnership and sponsorship, such as Starlight Capital, Fidelity, Clearing and Custody, Advisor Analysis, Analyst, Morningstar, Advisor Research Group, and our charity of choice, the Canadian Mental Health Association, and along with GWP Branding and Syntonic and our other partners. So thank you again for your time today. Any questions or concerns, please feel free to contact myself or Sarah, and please continue to spread the word. Let advisors understand the disruption that we here at Pascal are bringing to the marketplace and innovation. And we continue to ask you to stay safe, continue to physical distance as we open up the economy. Thank you and stay safe. Bye-bye.